Hi, I'm Chance Finucane, Chief Investment Officer at Oxbow Advisors. Here are the things that caught our attention over the past month. One reliable signal that a recession is looming is when a series of leading economic indicators reports declines for an extended period. To our surprise, the LEIs declined for nearly 2 straight years without a recession starting. February's reading reported positive growth, and bulls argued this risk is in the past. However, the latest reading for March was returned to negative numbers. We still consider this a headwind to monitor. Employment has remained strong for longer than expected, but there are components that remain concerning to us. Most of the hiring in the United States is done by small businesses. Therefore, it's noteworthy that the National Federation of Independent Business is reporting weaker plans by small businesses to hire in the next 3 months. The black line on this chart has been inverted, so a rising black line means fewer plans to hire. When hiring plans are fading, the unemployment rate tends to follow by increasing as well. When it comes to inflation, a lot of attention is paid to big factors like shelter and energy. Shelter inflation is expected to continue to come down, while energy inflation is picking back up with the rising price of oil. One key area we want to follow, though, is core services inflation. Multiple core or super core measurements of inflation were showing deceleration for most of 2023. The problem for the Federal Reserve is these measures are increasing again. This is another reason why we don't expect the Fed to begin cutting the Fed funds rate anytime soon. If interest rates keep going up, it will be small cap companies that feel the most pain. A big jump in maturing corporate debt is coming in 2025 and 2026. If interest rates do not come down by then, it's going to be an issue for companies with leveraged balance sheets. This is more of an issue with small cap stocks than it is with large cap. When evaluating a small cap stock, we believe one of the 2 most important variables to track is the amount of financial leverage the company has. We do not want to take on that kind of financial risk with a smaller business when there are fast-growing large stocks available with pristine balance sheets. Higher interest rates are impacting consumer balance sheets as well. The New York Fed survey of consumer expectations looks at the percentage of consumers expected to miss a minimum debt payment over the next 3 months. Outside of the peak of the pandemic, this is the worst the debt delinquency numbers have looked in over a half-decade, and the trend is continuing to worsen. Technology has been the best performing sector over the past 18 months. However, we are seeing some volatility with stocks in the tech sector more recently. We think it's important to be able to diversify outside of the tech sector and have some things that can perform well even if this drawdown in tech continues. There are several areas that stand out to us. First, for the past 40 years, consumer staples and utility stocks tend to outperform when tech underperforms and vice versa. Second, energy pipeline stocks have had almost zero correlation with tech stocks over the past 3 to 4 years. Finally, gold bullion and gold stocks have had some strong recent gains. This is a commodity that the best risk-adjusted returns come from owning some when the price momentum is positive over the past 9 to 12 months. That's the case today, and we will continue to have some exposure to gold for as long as this run lasts. Hopefully that gives you an idea of some of the economic variables we're tracking, as well as some non-tech areas to go with your portfolios. If you have any questions, please contact us. We provide the information that we think is most valuable to investors. If you'd like to follow our work more closely, please subscribe to our YouTube channel.